Hi, I'm Rachel and welcome to Yield and Grace. Welcome to our second episode of Generations of Wealth, where I sit down with my dad and we talk about the importance of creating generational wealth and our different strategies and mindset. So I'm very excited for the second episode. How are you feeling?
Wonderful.
All right, well, let's get started with any new additions that we have added to our portfolio lately.
Do you want to go first?
No, I'll let you go first.
I added Clorox, a dividend stock, a block of it, due to the fact it's near a 52-week low. Love the company. For the price, you can't beat it. You're not going to see it too much lower, I don't think, and for too much longer. I added another block of Constellation brand, like Corona, so that's a favorite of mine. And I'm looking at Procter & Gamble. I like the company, and I'm waiting for my price to hit, and I'd probably be buying up more of that. I also picked up some more Chevron right before earnings on Monday, just to see what it would do with the earnings, and of course it did great.
Now, do you have a watch list of all the companies that you like, that you keep an eye on when they hit their 52-week lows for then you to be able to buy?
I have, on Yahoo Finance, I have a list of 400 stocks approximately that I have watch lists for, and strike prices when I get alerted when those get to my strike price. Not all I buy, most of it's just to watch, but there is considerable amount of ones getting near 52-week lows right now that I'm very intrigued about.
So then I have a question for you. For someone who's just starting out or is thinking about beginning their investing journey, are you the kind of person who waits until a company that you like hits a 52-week low, or will your entry point be at any point just because you love the company?
If I'm going to be adding a new company onto my portfolio, I'd like it to be near the 52-week low, just for the bargain purpose. After I own it, I'm willing to add more at any time. Once I get my base in, I'll buy maybe 100 or 200 shares at the bottom, and then I'll add consistently for as long as I own the
But what if you were just going to be starting out?
If I was starting out, what I would do is I would probably go on Yahoo Finance, pick about 10 stocks you like, and see what prices are at. If they're near 52-week highs, I wouldn't advise. I mean, you can do whatever you want. The financial information that I'm providing, but I'm just telling you what I would do. I would set a strike price and an alert when it gets near your number that you think you'd like to pay for it. And they don't have to be expensive stocks. It could be even a drop of 50 cents, just something that you feel comfortable starting your journey with.
Mm-hmm. See, for my strategy, being that I'm consistently using drip in all of my stocks, I'm getting paid on a weekly basis, your entry point is not as important, being that with drip, it's consistently helping you dollar cost average down. So for example, when I bought Misty originally in the 30s, now my dollar cost average has dropped because I'm consistently dripping into the fund. Same with Coney. I don't remember what the exact number was when I first bought it, but now my dollar cost average is in like $7 range. So when using drip, it does really allow you to not only compound very quickly, but consistently dollar cost average every week if the stock is going down.
And with an ETF, I agree. Really, the entry point doesn't matter as much, but when you're buying a stock to do cover calls on, and you want something long term, you want to try to get it at a price you're comfortable with. When Constellation Brands was $30 higher, I still like the company. I just wasn't willing to pay that. I mean, they pay a nice dividend. Same way with Target. Target went down to the $80 something range. I had to start buying it. Same with UPS. Went down to the $80 something range. You just can't turn down a $1.60, $1.70 dividend on a company. Okay, it might cut its dividend, even if it cuts it in half. That's still an incredible amount of return you're going to get.
Yeah, and some of the new holdings in my portfolio I mentioned in a few of my other videos, but the newest ones were 2 rec share funds, NVII and TSII, to pay me every Wednesday.
And why'd you pick those?
I chose those because I like their distributions. They're pretty steady and consistent, and they align with being that I sold my NVIDIA. I still wanted NVIDIA exposure, so I felt NVII could give me that in a more consistent way. And right now I started with, I don't think I have 100 shares. I think I have 100 shares of TSII, but not yet of NVII, but a slower and steadier build. So I'm looking forward to that. And also the TSII pairs well with my TSLW of my Round Hill Tesla fund. So the exposure to Tesla.
I will be looking to add more dividend stocks that pay in October and November, because a lot of my ex-dividend dates are November, paid in December. Almost 90% of them get paid in December. So that's why I like Constellation Brands that'll pay in November, and I got to start looking into distributing it a little bit better.
So I got a lot of questions about what your thoughts are on margin, and one question in particular I wanted to cover so that they can hear your perspective on that. Sure. Stefan Martin said, just curious about both of your thoughts regarding the use of margin. I know, Rachel, you use it, but how do you explain to others to place your securities on drip but then use margin, which the loan per se would never get paid, just only the interest would be deducted from your buying power, but if you borrow using your margin to purchase more securities, then your buying power also increases, which basically is the buy, borrow, and die strategies.
Again, I can't speak for ETFs, but my strategy, I use margin all the time. If you're paying 6% of on your margin, and you can make 20, 30 or more percent return on that money, why would you not use their money? As long as you have a buffer. I run 30, 40, 50 contracts a week with cover calls. At any point, I mean, I've come close to margin calls many times, and I just rolled out a few things to the following week to have even a bigger buffer. So for me, I can't say it as far as dripping with like an ETF, because the only one I drip on ETF is BidX, but I'm up so much on it that I would never be margin called on it.
No, they're asking because I use drip, and I also use margin.
Yeah, but that's, you know.
But a thing to understand how it works behind the scenes is when you're dripping your funds, that's counting as collateral for your new shares with your margin. So I understand what he's saying of not paying back or down your margin, but it is increasing your buffer because you are having more shares, and that means you have more collateral. But for paying down your margin, how do you pay down your margin?
Again, when I do my cover calls every week, sometimes I put money towards the margin, sometimes I don't. Depends on what I'm buying and the time of year I'm buying. Right now, there's a lot of things I'm interested in and I'll be buying more of. Come the beginning of the year, I probably will knock my margin down 20 or 30%, as long as I don't see any great deals coming down the road, because that's what changes everything.
Mm-hmm. See, for me, with my margin has allowed me to get to the point where I am today, of having a $300,000 account and making almost $30,000 a month. At any time, I could turn my drip off and pay down my margin. I'm just choosing not to do that right now. But at any time, I can do that, which is the beauty of making $30,000 a month. I can pay down my margin quickly if I wanted to, and I could turn drip off at any time. So I think the margin has really helped my strategy snowball and accumulate a million times faster than it would have if I didn't use margin. And like you said, my Robinhood margin interest rate is like less than 5%. I think it's 4.75% right now. So that's insane. You're not going to get that anywhere else.
Yeah, to make that kind of money, to make just double that, it's silly not to be using their money. For me, it's volume. I run so many contracts every week that not to use margin is just taking away my buying power. The cover calls I can do on 50 contracts compared to 25 is amazing, the difference of money you're bringing in.
Mm-hmm. And I will admit, when we first started this, I have been an extremist on my journey. Like, when you start seeing what you're getting paid and the shares you're accumulating, you want to keep pouring into it and making more and having that snowball get bigger and bigger and bigger and bigger. So I have no problem admitting that I have gone all in on this because it's working, and that's what's gotten me to
I wonder where you get that from.
So obviously, like I always say, I don't encourage anyone to do what I do, but it works for me, and I feel I have an obligation to share something that has completely changed my life. And at any point I can change my strategy. I'm going to be working on a growth portfolio that I'm working on from scratch. I'm going to do a high yield ETF portfolio that I start from scratch. I buy Bitcoin every single day. So I think that it's important to understand I want to be more diversified, and I'm going to get there. But right now, this is just what's working for me, and I just want to be able to share that with you guys.
Yeah, that's one thing people don't understand. They see her portfolio, and they comment that this is all she's going to do. They don't know what goes on behind the scenes, or what we talk about, or strategies that my wife and I and Rachel come up with. Yeah. We're constantly reviewing everything weekly, if not daily. But daily. Since we work together, we're always around each other, and we're sending messages back and forth all the time.
Yeah, and I think that's why it's so important for us to do these kinds of videos, so that you guys can get a more behind the scenes look of what we're talking about and our mindset and our strategies moving forward, so that you are also in the loop of like how this is all unfolding. And being able to share my journey with all of you is such a cool thing, because I'll be able to look back on it and see like at what point I changed this, or I continued to do this that continued to work for me.
And that's why we encourage families to get their kids involved, so that their kids might have one idea and the parents might have one idea. But here's a perfect example. Two polar opposite ideas, but kind of going to start blending a little bit of each with each other. And the long term is to make generational wealth.
Yeah, and not one strategy is right or wrong. It's just that if we're able to work as a team, if you see your family as a team unit, and we can help each other get to our ultimate goal, that's what matters most.
Absolutely.
Another thing a lot of people asked was they want to hear more about your covered call strategies.
I prefer to make, I have numbers in my head that I try to make. Minimum $50 a contract, up to $200 a contract. If I can't make that a week or every 2 weeks, I have a tendency to stay away from doing covered calls on those stocks. I might buy a block of them just to hold them if they're at the lows, just to get the dividends and wait till they recover. But most of the time when I look at a stock, I look at their covered call and their dividend to make sure it's worth me investing in.
Okay, so like for example, let's use BitX for an example. When you go to do a covered call on Monday on BitX, do you do it in the money or out of the money? And do you do it for the week or a few weeks out?
Most of the time I'll do it same week. I usually close out my contracts on Friday to get the additional time, and I'll do my cover calls on Friday for the next week. So I'll close them out for maybe 2 cents, 5 cents, and then I'll do them with the extra time to do them for the following week. Especially like BitX. BitX is great because of volatility. You can get $100, $150 in a week. Not too close to the money. I don't do anything at the money, but $5, $6, $7 out of the money. It's usually a firm. And if I have to go out 2 weeks to get that number, I will go out 2 weeks, but I try to stay within a week. Again, when you're doing cover calls, a lot of times it doesn't have to be big dollar stocks. Smaller stocks, more volume can make you just as much as a bigger stock, especially if it's a stock that has a lot of volatility. I know a lot of people like talking about SoFi and these other type of things, and they're all good. I mean, they're great starting points, and they work for a lot of people, but I kind of stay away from everything that you see that pops up on YouTube, the next big stock to chase, or this is gonna go 10x.
Wall Street bets.
That's fine if you want to chase that stuff, but I buy what I know, I buy what I use, I do cover calls on them, and it seems to work out great. I've had no complaints. Yeah, I've gotten caught sometimes where price has gone up too much, and I just keep rolling it and collecting my payments on it.
And I also have done cover calls as well when you taught me how to do them. But I like more the fact that like Yield Max funds do the cover calls for you. So I have gotten burned a couple times like on Rivian earnings and stuff like that. So
you do have to watch earnings when it comes to cover calls. Not only do you have to watch earnings, you have to watch, ex-dividend dates a lot of times.
Yeah. So it can turn against you. So I like the fact that with these high yield ETFs, like Yield Max, who do the cover call strategies, that they do it for you and you are just simply collecting the distribution from it. I like that. It's a more hands-off approach. You don't have to be so involved. You don't have to keep an eye on if the stock's going above your strike price or if it's staying below your strike price and rolling it and all these things. Is it a fantastic way to make additional income? Absolutely. But it's definitely more hands-on, and I prefer, as an investor, I have learned I prefer a more hands-off approach.
But the other thing too is they don't offer a lot of this. They don't offer Constellation brand and a ETF. They don't offer M&T Bank, United Healthcare, Humana.
Yeah.
These are not offered in ETF. So most of the things I own will not be ETFs. They will be single stocks. So they don't even know, like I could say, oh, I get it in an ETF if they had it.
Yeah. No, yeah. But like, for example, I own 100 shares of MicroStrategy. Rather than me doing a cover call on MicroStrategy, I would prefer to buy Misty where they're doing it for me because I love the MicroStrategy stock and I don't want to take a chance of those 100 shares getting taken from me.
Right, but I'm like watching Procter & Gamble right now. Love the products. Bounty, Charmin, can't go wrong with those. Again, there's going to be no ETF, very little volatility.
Yeah, that I totally get, and I thank you for clarifying the ones that you are investing and doing the cover calls, and there are no ETFs for those. No. That's a really good point to make.
And when a lot of them do recover to their normalized price range, very little movement. They're very steady, which I like. I like knowing how much I'm going to make every week. For a while there, I was making the same every week for like 4 or 5 months. There was no change, and every week was pretty much predictable, which I happen to like a lot.
Now, does it scare you doing a lot of contracts on cover calls? Or do you think at first it's a little scary, but then as you do it, you get a stomach for it?
No, the only scary thing I do is my day trading, which sometimes I realize how much money I'm buying a block of 1,000 shares of something and doing a 20 or 30 minute flip on it, and then I realize that I might be the degenerate, not you. But as far as shares, it doesn't faze me at all. I mean, if I have 2,000 shares of something and I want to do 20 cover calls on it, just more money. It doesn't faze me at all.
So are you saying that the people who attack me on my YouTube comments, if they only knew?
Yeah, but I'm at the age where I really don't care. Most of the comments that are made against my daughter are speculation on their part that whatever they think is going to work or not work. Judging her, which they don't know about our family, and I know you said there was somebody was questioning her religious aspect because of her talking about wealth enhancement, but all through the Bible, obviously they never read it, because if they talked about Job or David or Jacob or anybody else that had massive wealth made throughout the Bible, blessed by God, again, there's no reason the church would exist if there was nobody donating money. They don't know what we tithe or what we donate or how many kids that we sponsor.
Yes.
They don't know any of that.
Anything about our personal life.
And we're not going to volunteer most of that because that's irrelevant to the journey that Rachel's on. But on the other hand, too, it's easy to judge what you don't know.
Yeah. And to that point, I want to make it very clear that although making money is great and generational wealth is fantastic. My relationship with God is number one in my life. He could take everything from me right now and I would be okay with knowing that he is in full control of my life and that I am completely in surrender to him and what he wants for my life. And that was the whole purpose of me creating this with the name Yield, because I am chasing high yield ETFs and I love them, but Grace is just as equal to Yield in my name, and that is the mission that I have to also be able to spread the word about God and the gospel. So I never wanted to be mistaken of what I feel is my mission through this. God is number one in my life and nothing will ever come before him. And it's about what your heart is. If your heart is worshiping money, then that's not good. That's horrible.
And at no point did anybody ever suggest that is the goal here.
At all. Ever, 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 ever. My heart is in worshiping God and praising him through everything and living in constant gratitude. And I really hope and pray that that is reflected of me in my videos. So I never want that to get twisted. Yield and Grace is about making generational wealth, absolutely, but it's about keeping God number one in your life. So. And
when Rachel started this, I never realized how many FaceTime calls or Zoom calls that it would start young people or older people. Just the other day she had us on having people start up opening accounts. It is so amazing, and for people to even want to knock the thought of helping even one person get started in a journey which could alter their life or their children's life, it seems silly. There's so many other things you could go focus on and go knock. And I mean, look at politics. You can go anywhere on the
go
internet.
Attack them.
Go attack somebody that really wants to engage in that, because I'm not that person. I really couldn't care less.
Yeah, and I'm starting to
not care either. A little bit.
Why do you feel most people fail to build wealth regarding emotional decisions, lack of patience, over leverage, etc.?
Procrastination is number one, never getting started, and they'll start out the same way I use the analogy of working out. Everybody wants to work out and look great until you actually have to go and do it. Mm-hmm. When you start investing money, you're not going to see huge numbers unless you gamble on calls and puts, which I do not recommend to anybody, especially people starting out. No. It's a great way to lose everything you have. Yeah, no. On the other hand, if you start out slow and you start out sensible, and we were talking to a group of people the other day, start out $10 a day.
Yeah.
You can't really get hurt. I mean, what's it, a meal a week that you might be losing? And spread it out over 3 or 4 things. Chances are of all 4 things not working out are minimum. And we explained to them about looking at things that are on the dips to buy in, and just a safe way of doing things. But I think especially generations today, people don't want to wait 10 years. They want to know, how can I make enough money where I don't have to do anything tomorrow?
Yeah.
It doesn't work that way. Yeah. You have to really be patient. Some will work out great, some won't work out so great, but the key is patience. Time in the market beats timing the market.
Yeah, and I think for me, being that I have been a beginner sooner, or like I have been a beginner now, you were a beginner a little bit longer ago.
Thank you.
I'm more of a beginner coming off of beginner. I think that it's really easy to get intimidated by investing in the stock market, and you hear these horror stories of people saying that they lost everything and that it's only going to go down, the market's going to crash. And I think that when you feed into that, it's so easy to say, I want nothing to do with that and I'm going to do something else with my money. Whereas if you go into it with a rational mindset and a correct mindset of saying, I want to invest in the companies that I believe in, and this is a long-term game. This is not a get-rich-quick scheme. I think that you will have a better head on your shoulders to block out the noise. I mean, there's some people saying the market's been gonna crash for 30 years now.
Yeah, I've been watching Peter Schiff tell me it's been gonna blow up since '08.
Yeah.
Blew up originally, and then it was gonna blow up again.
Yeah, so I
Waiting on
think you have to stand and lean in on your convictions and block out the noise. Like I always say, do I think Tesla's going to zero? No, I don't. Do I think Palantir now is going to zero? No, I don't. And just investing in the companies that you really believe in, that you know are going to be here long term, and making your money work for you. That's amazing. But it also does take patience. That's why they say patience is a virtue. Those get-rich-quick schemes are unrealistic and require a lot more risk than what we're talking about.
Well, the other thing that ETF investing has changed in the last couple of years is most people would be like, oh, $400 for a stock? I can't afford that. What am I going to buy? One share a year? It's useless. I'm not going to even bother trying.
Yeah.
But now that same $400 stock in an ETF, 25, 30 bucks. Oh, okay, maybe I can get 10, 20, 30 shares and I can get dividends on that. Okay, great. It actually opened up a lot of what the initial intimidation is the prices, some of the shares are just insane. Costco, $1,000. I mean, like if I love Costco, am I going to buy 100 shares? I mean, I'd have to mortgage my house. But then people start all of a sudden like, oh, okay, well, maybe I can get into something a little different and be able to make it work for them.
Where these ETFs provide exposure to the companies that you might love, and you get paid along the way. Like, you're literally getting paid every single week now for having exposure to that company. And there's nothing that anyone says that you can't buy the ETF and also the underlying stock. You can have a strategy, or when you get paid the distributions, put them in a long-term play that you want, that you think is going to be a good long-term. That you can create your own strategy that works perfectly for you. So I think that's another important aspect to remember. When someone is simply sharing what works best for them, you can do your own research and say, wow, that's great, valuable information. Let me see how I can tweak that works for me in my life and my future goals.
Well, it's the same thing you have about getting dressed. People might like the same type of clothes, but they modify it to what their personality. They wear it differently, or they just accessorize differently.
Exactly.
That's what investing is. You take an idea, and you take there's so many great YouTubers out there now that are worth watching, not only Retiring Dividends or the Average Joe. I love watching him.
What advice would you give to beginners who feel they are overwhelmed with too many choices?
Limit the choices. You have 500 options. Scratch off 50% of them that you have no interest in. Narrow it down to 2, 3, 4, 5. All of a sudden now it's not so overwhelming. Focus on those. Set your alerts or your watch list to those. Maybe do a hypothetical portfolio with just those, and just eliminate a lot of the noise. It's easier to focus on 5 things than 500.
Yeah. And I think that there's so many tools out there nowadays. Like you said, you can make hypothetical portfolios and see how
I do it all the time.
Yeah,
I'm still making new ones.
I do too. And nowadays there's so many tools for you to be able to make the best educated decisions that you possibly can for not only you, but for your family as well. So I think that, like you said, start with a few. I started with only a few funds, like I think it was Misty, Coney, and Nvidia. I started with those 3 that I just kept pouring into to eventually get to a goal of 100 shares. And then once I reached 100 shares of those, I picked the next one, which I believe was Tesla. And then I started pouring into those 4. And then once I reached a new goal of that, then I picked a new one. So I think if you're able to remove the overwhelmingness and just go into it gradually, and see how it goes from there. And like we always said, at any time you can change your strategy if it's not working out. If all of these high yield ETFs went to zero tomorrow, I would still want to invest just in something else. I would just modify my strategy. And I think that's important. And when it comes to your kids also, and setting up accounts for them and trying to get them more involved, don't overwhelm them. Start with something easy to understand. Start with making those connections with them, and then have it evolve naturally from there.
I would like to say one thing. I would suggest, not financial advice, not saying this is what you should do. This is what my family has done. Rachel, my wife, and I all have different holdings. Some are the same, but a majority are all spread out. If you were to do this with your husband, wife, boyfriend, girlfriend, and your kids, try to diversify everyone a little bit. Don't have them all exactly following the same. It's better to have 3 going at the same time, and then you also have a way to see what's working at each one, and then a way you can modify them as you go, or things you want to add on. Your kids might want to add on something that you're not into, or you might want to add something. That's great. Yeah. Diversification amongst the family is wonderful also, and should be encouraged.
Yeah, we highly encourage that for our family, diversification.
There's no right or wrong way to invest. It's people always say, well, I'm not a financial advisor, and I don't think I could do what they do. You know, if you have a financial advisor that's shooting to make you 10% a year, you know, you're really not losing a whole lot trying to start out small with yourself and seeing how you do. That's kind of like what I did, and all of a sudden it was like, and then you got to see 10% is okay, but you could just do a small closed-end fund and make double that easily without even trying. And I know supposedly professionals are great to deal with, especially when it comes to trusts, tax help. Certain things you should always use professionals for.
100%.
But when it comes to your money and what you should own or not own, you really should have a say in it. If not all of it, it's great to have, a 401k with your business. Leave it in there. That's great. It's great to have, bonds, and if that's what you're comfortable owning, that's what you should do. But start a small account. Try it on your own. You'll enjoy the fun of it, and the family part of it will be great too.
Well, as always, my videos are not financial advice, and you should always do your own research before investing. We are just simply sharing our journey, our story, what has worked for us, so that you can have better tools in your tool belt to be able to create generational wealth for you and your family.
And good luck on your journey.
Yes, and we will see you next time for episode 3 of Generations of Wealth.